Alright guys, welcome back to Solo Mega Machine, and I need you locked in from the very first second because what I'm about to break down is not some recycled headline or surface level narrative. This is the kind of data that moves markets and blindsides anyone who isn't paying attention. And if you've ever wondered why crypto suddenly melts faces after long periods of boredom or fear, today you're finally going to understand the mechanism behind it, because the truth is brutal. You're not trading charts, you're trading the consequences of government spending, and most retail investors don't even realize it. Let's get straight into it. The U.S. Treasury just posted a $284 billion deficit in the month of October alone, the worst opening month to any fiscal year in U.S. history. Let that sink in. This isn't a minor overshoot. This isn't a rounding error. This is the government lighting money on fire faster than at any point ever recorded. And before anyone shrugs this off as normal government stuff, remember this. Markets don't ignore deficits. Liquidity doesn't ignore deficits, and crypto absolutely does not ignore deficits. Here's the reality when they stop. When deficit spending is exploding, it's a bright red signal that the U.S. economy is weakening behind the curtain. And anyone with money, including institutions, sovereign funds, hedge funds, and high net worth individuals, starts doing what people always do when they sense instability. They move into alternatives, assets outside of the traditional system, assets that can't be inflated away, assets with asymmetric upside. And guess what those are? Bitcoin, Ethereum, XRP, basically this entire asset class. Now, don't take my word for it. The data speaks for itself. The last time we had deficit levels anywhere close to what we're seeing today was during 2020. And what happened in 2020? Only one of the biggest, fastest, most aggressive bull runs in crypto history. Bitcoin went from 10,000 to 69,000 in a year. Ethereum went from 350 to nearly 5,000. Every major altcoin exploded, and XRP, despite being handcuffed by a lawsuit, still surged. That wasn't luck. That wasn't chart magic. That was massive deficit spending colliding with the search for alternative stores of value. And here's the part most people fail to understand. Big deficits aren't bullish in the moment. They're bullish in the aftermath. Because deficits eventually force central banks into a corner. They have to stimulate. They have to loosen. They have to print. They have to push liquidity back into markets because tightening becomes politically impossible. So when you see a deficit like $284 billion in 1 month, you're not just seeing a number, you're watching the setup for the next mega cycle forming right in front of your eyes. And this is where retail always screws up. They look at a giant deficit and panic. Institutions look at the same deficit and start positioning. They don't wait until the stimulus begins. They buy the assets that will run once the liquidity hits. That's why smart money makes the life-changing gains and retail walks away with excuses. Now, here's the kicker. Well, not only is the deficit blowing out right now, but quantitative tightening ends on December 1st. So, what do you think comes next? More tightening? No, that ship has sailed. Inflation is slowing, pressure is rising. The political cycle demands relief. And the Treasury needs cheaper debt. There is only one logical outcome: liquidity expansion. And liquidity expansion is the oxygen of crypto bull runs. So when I see people ignoring this deficit data, pretending it doesn't matter, obsessing over a daily candle or a small retracement, I can tell immediately who understands macro and who's just staring at price. Because the people who actually study this stuff know exactly what's forming. This is the same playbook that ran in 2020, and it's happening again, just with even bigger numbers. The truth is simple. Crypto thrives when confidence in fiat weakens, and nothing weakens confidence faster than uncontrolled deficit spending. You're watching the foundation of the next aggressive cycle being built in real time. The question is whether you're positioned or just watching. And if you think this doesn't impact XRP directly, you're delusional. XRP is the asset that benefits the most from liquidity, capital rotation, macro instability, institutional rebalancing, and renewed risk appetite. The moment liquidity returns, assets with strong narratives and real use cases don't just move, They launch. This deficit report isn't noise. It's not background commentary. It's the spark before the ignition. Here's where things start getting uncomfortable for anyone who thinks today's market is random, because once you actually overlay today's deficit data with what happened during the COVID crash, the correlation smacks you in the face so hard you can't unsee it. Let's break this down without sugarcoating anything, because this is exactly the point where most people either wake up or stay broke. Back in 2020, deficit spending didn't just increase, it detonated. The fiscal year 2019 deficit was $984 billion. The fiscal year 2020 deficit jumped to $3.1 trillion. That is a 215% increase. If a private company increased its spending by 215% without increasing its income, it would be bankrupt instantly. Governments don't go bankrupt, they print their way out. And that printing is what sent crypto into orbit. One month in particular matters, October 2020. The US recorded a $284.1 billion monthly deficit, which at that time was the largest in history. Sound familiar? Because we just hit nearly the same number again in October 2025. You're literally watching history repeat itself, tick for tick. Now, pay attention, because this is the part people always ignore. When that 2020 deficit spike happened, Bitcoin was trading at around 10,379. Ethereum was trading at 380. XRP was under 30 cents. Retail was terrified. The headlines were apocalyptic. The sentiment was bearish. And yet, within 12 months, Bitcoin peaked at $69,000 and Ethereum at nearly $5,000. Here's the brutal truth. Bull markets are born from despair and deficits, not optimism. And if you need proof, the charts deliver it without emotion. Bitcoin 500% after the deficit explosion. Ethereum plus 160% after the deficit explosion. Altcoins, many must 2,000, 10,000%. Why? Because when deficits blow out, fiat confidence collapses. People start realizing the dollar isn't a store of value, it's a melting ice cube. And once that happens, money migrates into harder assets, crypto, precious metals, commodities. Now, in 2025, we're seeing the exact same setup, but on a larger scale. Because the economy is weaker, debt is higher, and the political cycle is more desperate. That means the reaction is likely going to be even bigger. And here's the part I need you to fully internalize. Crypto didn't moon the moment the deficit spike happened in 2020. It took 12 months. That's a pattern, a measurable, repeatable pattern. Liquidity changes take time to ripple through the system. The moment the government starts printing or borrowing aggressively, the initial reaction is confusion and fear. But once the liquidity works through the economy and financial markets, risk assets explode. That's why screaming, "Why isn't XRP pumping yet?" right after a deficit spike is clueless. This stuff plays out in macro timeframes, not your daily trading emotions. Now let's tie this to XRP specifically, because XRP doesn't behave the same way as Bitcoin. Bitcoin is driven mainly by macro liquidity and retail mania. XRP is driven by macro liquidity plus institutional flows plus regulatory clarity plus utility cycles. When you combine these four factors, XRP tends to lag Bitcoin at first, then catch up violently in a compressed window. Every cycle has confirmed this. So, when I hear people whining about slow movement on XRP, it tells me they don't understand that XRP is an instrument built for the second half of macro cycles, not the first. The more liquidity enters the system, the more capital seeks scalable settlement layers, and that is XRP's territory. Now, layer on the fact that quantitative tightening ends on December 1st. This alone is massive. Markets bottom during QT, markets explode during QE. And yes, QE is coming, because deficits at this level cannot be sustained without the Fed stepping in. The political pressure is too high, the debt servicing cost is too high, and the economy is already showing cracks. So if you're sitting there thinking the deficit is bad news, you're looking at this backward. Deficits are the gasoline. QE is the match, and crypto, especially XRP, is the dry forest waiting to ignite. But here's where retail usually sabotages themselves. They assume the moment they hear QE coming, everything should moon immediately. No, it takes months. It requires patience and conviction, two things most people don't have. The point is simple. The deficit is already doing its job. Liquidity injections are coming. Institutional positioning has already started, and macro conditions are aligning for the same setup we saw in 2020. If you understand that, you don't panic on red candles, you accumulate them. Here's where most people get slapped by reality. And honestly, they need it, because if you don't understand this next section, you'll keep repeating the same dumb mistakes that wipe out 95% of crypto investors every single cycle. Let's break down the real reason the market pumped today and why most retail traders will misread the situation completely. Everyone on social media is screaming what markets are pumping because of deficit news. Wrong. Retail doesn't understand macro. Most people don't even know what deficit spending means, let alone how it correlates to a liquidity cycle. The real reason the market moved today is very simple. Retail traders reacted emotionally to the leaked information about the next Fed chair. The new pick is extremely dovish, meaning rate cuts, looser monetary policy, and the strong likelihood of quantitative easing returning. That alone is enough to convince retail that the good times are coming back, even if the macro structure hasn't fully shifted yet. Bitcoin immediately bounced above $90,000 and XRP started showing signs of momentum. But here's the brutal truth most people need to confront. Retail always reacts too early and too emotionally. Institutions wait. They accumulate quietly. They don't chase pumps. They buy despair. Right now, retail is celebrating green candles without understanding the larger picture. And if they keep celebrating without discipline, they're going to get dumped on again, because the short-term setup still favors downside before the real upside begins. That's why you keep hearing me drill the same point. You don't buy into excitement, you buy into fear, and most people simply don't have the guts to do it. Look at 20,820. After the deficit spike, Bitcoin didn't instantly shoot to 69Ks. It took a year of boring sideways action, red days, doubt, fear, and constant media panic. Anyone who bought emotionally or tried to time the exact bottom got washed out. The people who won were the ones who accumulated during fear and ignored the noise. Same applies today. The deficit just printed the highest October number in US history, and yet most of retail still can't see the writing on the wall. They want instant gratification. They want the pump while the liquidity hasn't even flowed into the system yet. Let's talk XRP specifically here, because XRP amplifies this emotional problem even more. XRP is the most emotionally triggering asset in the crypto market. Everyone either hates it or worships it. There's no middle ground. So, what happens? Retail traders swing wildly between euphoria and despair. One green candle, it's starting. One red candle, it's over. Meanwhile, institutions, the ones actually moving sizers, are doing the opposite. They buy structured dips. They follow liquidity flows. They front or run macro cycles, not emotions. And right now, institutions are doing something very simple and very predictable. They're positioning themselves ahead of QE, not during it. Retail is waiting for confirmation. Institutions buy before confirmation. That's why they always win. Now let's address the fear side, because this is where retail gets destroyed the most. Everyone says they want opportunity, but they melt down emotionally every time the market gives it to them. The moment they see 3 red candles in a row, they panic. They convince themselves the market is dead, and they start selling their bags right into institutional accumulation zones. This isn't theory. It's happening again right now. XRP is trading in a range between $212 and $229. Every time it dips into this range, people freak out. Meanwhile, the smart money and the disciplined individuals use that range to accumulate. You want to know the difference between buyers at $212 and buyers at $4, $8, or $10. Discipline, emotional control, understanding of macro cycles. If you're panicking at $2, you will panic at $8 and $10. The price isn't your problem. your psychology is. The people who win in this cycle will be the ones who understand two things. Liquidity drives crypto, not vibes. Macro cycles take time. You and retail fear is the greatest discount mechanism ever created. Right now, we're in the final accumulation window before things go vertical in 2026. QE is about to begin. The deficit cycle is pointing in one direction. Institutional flows are forming. Market structure is tightening. And yet, retail still doesn't see what's happening. If you don't understand this now, you will understand later. But by then, you'll be buying at much higher prices, just like people did in every cycle before. Now, let's cut through the noise and get brutally real about what actually matters over the next few months, because this is the part where most people either position correctly or blow their entire opportunity through impatience and emotional stupidity. Here's the core truth you need to get through your head. The macro shift that triggers a real bull run doesn't hit instantly. It builds like pressure in a system. Slow at first, then violently. Everyone keeps looking at today's candles like they mean something huge. They don't. They're noise. Retail-generated noise driven by the leaked Fed chair headlines. The real groundwork, the stuff that molds the next explosive move, hasn't even started yet. QT ends in days. QE follows. Months later, not minutes. We're 2 steps from the real liquidity pivot. QT officially ends December 1st. QE begins after liquidity tightness peaks. Historically, a few months later, this is where most people lose the plot. QT ending instant bull run. QE beginning. That's when the explosion starts. And if you don't understand the gap between those two events, you will miss time everything. Look at 2020. Deficit spike, QE wave, crypto top 12 months later, not 12 days, not 12 weeks, 12 months. People who expected instant gratification got wiped. The ones who patiently accumulated won. We are literally sitting in the exact same pre-run environment. Let me break down the similarities. Massive deficit spike, liquidity stress, Fed pivot toward easing, rates expected to fall, retail confused and emotional, institutions slowly accumulating, market sitting in the same macro structure seen before previous parabolic expansions. This isn't. It's data. It's macro. But again, that none of this means the market goes straight up next week. XRP's current range is a gift. Most people won't recognize XRP is stuck between 2.12 and 229, tightening like a coiled spring. Technically, this is the calm before the storm. Here's the hard truth. Most people will not buy in this range because it's boring and scary, but they will FOMO at 4, 6, 10, and 15. That's how markets work, not because of luck, because people suck at buying fear and excel at buying euphoria. XRP gives you 3 simple signals. If it hits $212, accumulation zone. If it hits 229, no FOMO, wait. If it breaks above 230, with conviction, momentum shift. But here's what you should really pay attention to. The Bollinger Bands. Tightening is warning you a massive move is loading. When BBs compressed like this, it's not random. It's the market signaling one thing. A violent breakout is coming. Direction short-term likely down. Mid-term explosively up. And if you can't emotionally handle that, you're not ready for what's coming. Your job right now is stupidly simple, but most people won't do it because it's not exciting enough. Accumulate dips. Don't chase pumps. Don't sell fear. Don't overthink the chop. Let macro liquidity do the heavy lifting. This is how grown adults make money in crypto. Not by screaming on Twitter. Not by panicking at every red candle. Not by looking for the perfect bottom because you're never going to nail it consistently. The people who win this cycle will be the ones who stay patient during the tightening phase. Ignore retail noise and influencer nonsense. Watch macro liquidity instead of memes. Position before QE, not after. Right now, everything is pointing to a 2026 blow-off top. Not blind optimism, but structural evidence. And if you want the truth that most people refuse to accept, here it is. Your bags are made in accumulation periods, not in breakout periods. Your profit is taken in euphoria, not in fear. Understand that and you'll be ahead of 90% of this market. Here's where everything comes together. the macro setup, the liquidity cycle, the deficit explosion, the Q2QE transition, the sentiment extremes, the accumulation range, all of it. Because at the end of the day, none of this matters unless you know how to position yourself without getting wrecked like everyone else who panics on red candles and FOMOs on green ones. The truth is simple but uncomfortable. The people who will win the next 12-18 months aren't the ones trying to predict every micro move. They're the ones who understand what the macro cycle is screaming right now. And it's screaming one thing: a massive liquidity wave is coming. The exact kind of wave that historically launches Bitcoin, altcoins, and yes, XRP into the kind of price discovery retail never sees coming until it's already 300 to 500% too late. The deficit is exploding, QT is ending, QE is loading, rates will drop, liquidity will return, and if history repeats even halfway, we're staring down a runway that leads directly into 2026 being another all-time high year for the entire crypto market, with XRP positioned to benefit more dramatically than most people can psychologically handle. And this is where you need to get brutally honest with yourself. Are you trying to time the bottom? Because if you are, you're going to lose. Timing the exact bottom is a fool's game. Even pros fail at it. What actually works is exactly what most retail avoids: buying fear and selling greed. You already saw the example. In 2020, deficit jumps, QE begins, liquidity floods the system, crypto bottoms. 12 months later, Bitcoin hits its ATTH. Not instantly, not emotionally comfortable, but mathematically consistent. And you're seeing the same behavioral pattern play out right now. Retail is panicking at every 2.12 XRP wick, screaming the bull run is dead, asking why it isn't pumping fast enough. Meanwhile, disciplined investors are quietly scooping up positions at the exact levels that retail is too emotional to touch. That's why the same 10% of investors make all the money every cycle. They aren't smarter, they just don't react like a clown every time the chart turns red. Now, let's talk XRP specifically, because your range here matters. You've got a compression zone between 2.12 and 229. And yes, it's tight and annoying and choppy, but this is exactly what a pre-breakout structure looks like. This is accumulation. This is patience. This is where smart money prepares and dumb money gets bored and leaves. If XRP taps 2.12, again, that is an accumulation opportunity and not financial advice, but it's the same behavior that outperformed the market in every prior cycle. If XRP bounces toward 229, you stay patient. If it breaks above 230 with strength, that's when momentum shifts. But the bigger picture here is that none of these tiny moves matter when you zoom out. If XRP really follows the macro structure we're tracking, deficit spike, liquidity relief, QE, institutional inflows, ETF accumulation, sentiment reversal, 2026 peak, then these $2 levels will look laughably cheap in hindsight. The smartest thing you can do right now is keep your strategy brutally simple. Dollar cost average into fear, scale out into greed. Stay away from over-leverage stupidity. Ignore influencers who promise overnight riches. Watch liquidity, not opium. And most importantly, stop expecting the bull run to behave like TikTok told you it would. Focus on macro, not micro, because the macro is loaded in your favor. For the first time in years, retail is panicking. Institutions are accumulating, the deficit is blowing out, QT is ending, QE is coming, and the liquidity cycle that has driven every major crypto bull run in history is setting up again. Whether the average investor is ready for it or not, look, here's the bottom line. XRP has one of the cleanest setups going into 2026. The macro is aligning, the technicals are aligning, the accumulation range is clear, the catalysts are stacked. And if you stay disciplined instead of emotional, you will be positioned for what comes next. And what comes next has the potential to be the most aggressive upside move XRP has seen since its 2017 breakout. This next cycle rewards patience, not impatience. Logic, not panic. Preparation, not reaction. Play it right, and the next 12 to 18 months could be the most profitable window you get in this entire decade. And as always, this is not financial advice. Do your own research, understand your own risk tolerance, and never invest blindly. But if you're paying attention, the signs are everywhere. The window is open. Now it's on you to use.